Well, that's good. I don't know. Yeah, we're gonna go with it. Once we make a decision. I hate those ones, right? Like,
Hi everybody, this is Hermon. I'm here, but I'm gonna be muting my speaker because my kids are with me.
No worries,
But I'm listening. Thanks, guys. Nice to see everybody.
hi, Herman.
Hello, hello.
Now we got Gina on here too. Nice, Gina. I'm glad you were able to get some time away from work. That's awesome. Yeah, I think we're gonna start pretty soon here. Yeah, but like that also another back to that variable versus fixed. Like some people just want the lowest rate right now, and that's kind of the only thing that they're looking for. So the variable, right? Like it's a no-brainer.
Yeah.
A lot of people are like, oh, I'm getting this rate, right? And it's something like that sounds like a variable rate. No, it's a fixed, and then they go back like, yeah, it's a variable. Like, it's just like it's so annoying, but yeah, it is the lowest rate right now.
Yeah.
Can I just say something about that? When you look at variable rate, so it's 2.45 prime right now.
Yeah.
Look at TD's prime rate. Do you see that it's 2.60?
Mm-hmm.
So theirs is always I thought it was 0.10 above, but now it's 0.15.
It's always been 0.15 above.
Has it?
Yeah, it's always been. So on their rate sheet, it'll actually have the actual rate. Like they don't have prime plus or prime minus on there just because it's confusing and they know that. Mm-hmm. So if you look at their rate sheet, it'll say like 2.2 or 2.3, right?
Right.
So then when we're telling clients, we don't tell clients prime minus 0.5. We tell clients realistic, like what the realistic, deduction from prime is. But yeah. I don't know why they do it that way, but they do, and it sucks, and it's just confusing. But they're the only.
Yeah, that's just weird.
Yeah, they're the only bank or lender that has a prime higher. So awesome.
Sneaky.
Yep. Yeah.
Really?
Yeah, but they're also there. I mean, their reduction for prime or the discount for prime also kind of reflects that too. So, like they'll instead, and it is. I think it is. Part of it has to do with marketing. So, yeah. Awesome. Okay, we're gonna get started pretty soon here, or right away actually. So I wanted to do this only because, again, I can sense there's a lot of confusion behind the switch transfer / refinance world. And oh, someone want to say something? No? Okay. If you guys aren't talking, if you guys can please mute your mics, that would be awesome because I get a lot of feedback back. And but yeah, there's a lot of confusion around the switch transfer / refinance world, and then people are confused as to who's paying for it. I know Gene had a question in regards to that. So I literally smacked this together like 2 hours ago. So if there's any spelling mistakes or anything like that, excuse me. But I'm gonna continue to add to this and hopefully make it better. So we'll get started. Okay, so first is the number one question is, what is a switch or transfer? A switch or transfer or renewal, as a lot of clients will call it, is the act of moving your client's mortgage from one lender to another upon renewal of their existing term, right? No change can occur to the existing mortgage amount. And there's an asterisk there, and I'll explain that just in a few minutes here. Clients, okay, so one second, this says covering the words. Okay, clients will have to requalify again if they decide to switch or transfer, right? So they have to qualify all over again if we're moving the mortgage over. Sorry guys, I'm just gonna go ahead and mute a couple of you guys here.
Hello?
Hey.
Oh, you hear me?
I can hear you, man.
Oh, amazing.
But not much longer because I'm gonna mute you pretty soon.
Yeah, that's good. I want that.
I'm just kidding. No, but you're muted. Just unmute yourself if you guys have any questions or anything. It just okay. So the clients will have to requalify again if they decide to switch or transfer their mortgage. Clients might not always be able to switch their mortgage if their financial situation changes. So if, for example, they are now self-employed and they had a job when they first got their mortgage, or their credit is now bad, or maybe they've missed some payments, they might not be able to switch their mortgage. So their only real option is to just renew with their existing lender, right? A switch or transfer is not a refinance. It's very important to make that distinction, only because, just in this world, it's important to call things what they are. Otherwise, it just confuses everybody. And with a refinance, the process is different. The costs are different. So again, switch or transfer does not equal refinance. Refinance is a separate transaction. So again, moving mortgage from lender A to lender B, And I'll go into kind of why someone would want to do that. So why would a client switch their mortgage? So number one reason is they're getting a better rate somewhere else, right? So like, let's say BMO, for example, is giving them 2.89 on a renewal, whereas Merrick's Financial's, giving clients 2.79. If they move their mortgage, they'll get a better rate. Interest savings, right? Again, better rate, interest savings. So pretty much anywhere where we can save them money. So again, Merrick's has a promotion right now, which will literally save like thousands of dollars off interest. Even if the rate is slightly higher, they're paying 3 months worth of interest for their clients, right? For example, lender promotions, like I just mentioned, Merrick's has a promotion, for example. You can find other lender promotions as well. If they're unhappy with their existing lender, again, this is not super common. It's not like you interact with your mortgage lender every day, right? So, but that is one potential reason why. And then to remove somebody from title or the mortgage. So this is considered an enhanced transfer, an enhanced switch. And we'll get into that in a second. And there's some extra steps that you might need to do. So we're not going to get too hung up on this, only because if you have any questions in regards to this, definitely reach out to myself or our amazing lender partners. But these are the reasons why somebody would switch. Okay, so what paperwork or information is required to switch? So again, your standard identification and service agreement needs to be signed, right? And we need the 2 pieces of ID, social insurance number, everything is identical when it comes to identification and service agreement. Standard income documentations, right? So we need the exact same documentation depending on the client's situation for their income. Existing mortgage statement. So they'll have to provide a statement that shows what their existing mortgage amount is. And typically you could just get this if they have online banking, you can just pull this from online or closer to their renewal date, they'll get something in the mail saying that, this is what your existing mortgage amount is. Pretty much just something that shows what their existing mortgage amount is. Existing property tax statement, right? Just showing that the property taxes have been paid and to show what that property tax amount looks like. If it's insured, we're going to need an existing insurer reference number, and we'll talk about that in a couple seconds. And then also property details. So I actually have a sheet. It's not with me right now. It's in the office. I should have brought it with me, but it's pretty much just it's like a worksheet that you fill out property details. So it just reminds you what questions to ask your clients, like square footage, what type of garage it is, what type of heating it is, that type of stuff, right? Because when it's a purchase, for example, that's all on the MLS. In this scenario, it's not a purchase, so we do need this information.
Message is received from +178-951-1716.
Sorry, guys.
Sunny, one quick question. We can share this later, so I don't have to take a bunch of notes right now, right?
No, yeah, you don't have to take any notes. I'm recording this, so I'll post a recording as well.
Okay.
Good to know. I will share it as well. So I'm just going to.
Hey guys, just on this slide, I'll just add with the current statement from the current mortgage lender, it has to have their name and the correct address. We find that sometimes if it's being pulled off of let's say EasyWeb from TD or an online banking system through mobile app, sometimes there's not a lot of information on those statements. So you have to go directly from your laptop or computer to get the full statement with the name and the address. And that's crucial for us. So just something to add there on the statements.
Yeah, that's a very good point. Very, very good point. And then another thing that's very commonly missed is a copy of their valid home insurance policy. That's one thing that we've missed a lot, right? Now we just know to get it. So again, the best things to do, guys, is just create checklists for yourself. Like if you know these are common things that you're gonna miss, just create a checklist, pop it next to your work computer, and you're good to go, right? So so these are some very basic documents that are required for any switch.
Sorry, Sunny, one last thing on that one. The reference number from your insurer is huge. You'll save the underwriter probably a day's worth of work if you guys can get that insurer number in your notes, and your deals will come back so much faster. Yeah.
And I have a slide specifically on where to get that number and all the information, all the numbers and stuff that you could call, right? But that is very, very important just because, again, it's super quick. When we're making that phone call, it takes us 30 seconds to get that insurer reference number. And I'll let you know kind of what that looks like. So how much does it cost to switch? In most cases, it's not going to cost your clients anything to switch or transfer their mortgage. As long as the loan amount is at least $100,000 and the term is at least 3 years long. So if they're renewing into a 5-year fixed or they're switching into a 5-year fixed and they have at least $100,000 a mortgage, at least a balance of $100K, the lenders will pick up the costs associated with it. So Gene, I know that you had a question in regards to that. The only time that there might be a charge is if the client's mortgage is registered as a collateral mortgage, right? Then there might be fees. or if the clients require some sort of title change, right? And fees may apply. And the reason why I say may is some lenders will charge, some lenders will not. Again, we have Merrick's on the call today, so they're actually not charging for collateral transfers, I think until like June or July, right? Right, Emmett?
Yeah, sorry. So it's just a 10 basis point comp reduction to the agent. So if we were to do the math, it's quite a bit less money instead of paying the actual fee. So it's going. They haven't disclosed a date yet. I believe it's going to be end of June. We'll see what they come up with. Hopefully they keep extending it for us.
Yeah, I read June 30th. But I could see that being extended. Like lenders always extend that. So more likely than not, you're not going to have any fees, regardless if it's a regular standard mortgage charge or a collateral charge. It's the lenders will pick up the costs associated with that switch, right? If your mortgage is a standard mortgage with no changes on title and clients are just simply moving over because you're getting them a better rate or you're getting 3 months of interest paid for them, there's no cost to the client, right? There's a little bit of paperwork. Of course, there's some paperwork, but we could potentially save clients thousands of dollars, right? At least a couple $100s, if not thousands of dollars. So that hopefully answers the question as to how much it will cost. Next question I get is, what rate will my current client receive? Well, it really depends. Again, it goes back to on a purchase, like what's my rate? Well, there's so many different factors that go into it. If the mortgage was previously insured at one point, right, and no refinances have been done to that particular mortgage, chances are 9 times out of 10, it's still got that CMHC or Genworth, the Canada Guarantee Insurance, a certificate or that policy attached to that particular property, right? And the client receives the insured rate regardless of what the loan to value is currently. So they could have paid off half their mortgage. If at some point it was insured, it's still considered an insured switch, right? As long as they didn't do anything to their mortgage in regards to like a refinance or something. If they've like at 80% loan to value currently, but they bought it with 5% down, we would do it as an insured mortgage, right? If the mortgage was conventional to begin with and the remaining amortization is less than 25 years, the value of the property is under $1 million, then the mortgage can be considered an insurable mortgage. So again, it's based on the tiers, right? So the different tiers will tell you kind of what rate to charge or what rate to quote the client. If none of the above apply, let's say it's like a $1.2 million property, that's how much the value is, it's considered uninsurable. At higher loan to values, when I mean higher loan to values is less than 80%, but like that between 70 and 80%. Again, look on your rate sheets. We got to make a determination whether, for example, uninsurable rate is better than, let's say, for example, like a Merrick's insurable rate at 80% loan to value, right? Because TD banks, they could be offering 2.79 uninsured, right? Or Merrick's could be offering 2.89 uninsured. Sorry to pick on that point, but that's the reality of it, right? Where Merrick's shines is, again, those lower loan to value. So under 65%, you're going to get insured rates, or insured rates, or insured mortgages, you're going to get insured rates, right? So that's kind of where you want to be looking. And I've emailed you guys that rate quote tool a couple times. So if you guys don't have that, or you want me to send it out again, let me know. Amit, do you want to add anything to that?
Nope, that was perfect. You're exactly right. And honestly, if you're in that 70 to 80% insurable bucket, like Sunny says, we're not great at that, but our low loan to values and our insured rates are going to be like money for you guys for sure.
Yeah, it's a slam dunk, right? I mean, like, even with buy down, these are like files that you like. It's like just do it. Like I always say, like just if you need to buy down a bit, just do it. It's either some money or no money, right? Now we're going to get into collateral switches or enhanced switches. Some lenders call it an enhanced transfer switch. Some lenders call it a collateral switch. If the mortgage is registered as a collateral charge. And so we went over this in the training, is what is a collateral charge? If it's a TD mortgage or an ATV mortgage, or if it has like a HELOC associated with it, any sort of revolving component associated with it, it's considered a collateral charge, right? Clients may have to pay FCT fees, and I say may because not every lender picks up those charges, or your comp may be reduced, typically 10 basis points. So when I say typically 10 basis points, I'm picking on Merrick's here, because they will not charge your clients anything. They'll reduce our comp by 10 bips, which again is 100% worth it for us to be able to do that transaction and the clients not have any sort of fees, right? Because that's the number one reason why people are like, no, I'm okay, right? Because they see that, that $600, $700, $800 in terms of FCT fees. So Merrick's will pay for the FCT fees. They're like, you know what? We're gonna pay for the fees, but we're gonna share those costs and they're subsidizing it for the broker. So they're just going to take 10 bips off our comp, which I think is very, very fair if it's a collateral switch. Again, minimum loan amount for that collateral switch where that applies, where that fee's covered, is going to be 150,000. Right, same thing. It's got to be at least a 3-year term. I think with Merrick's, I think they want at least a 10-year amortization left. I mean, is that correct?
Yeah.
Okay. Yeah. Some lenders are a little bit different. Some will just want 5. But again, like a lender like Merrick's will want at least a 10-year amortization remaining on that mortgage. Okay. So now.
Sorry, Sunday. If we just go back really quick, I know you said the collaterals are a little bit different for everybody.
Mm-hmm.
So I know you were talking about adding and removing names from mortgage. We can go into that later if you want, or do you want me to talk about it now?
No, go for it, man.
Okay, so for us at Merrick's, if the only way we can do a name change or a material change on a switch is if it's registered collaterally. And the reason for that is because we have to re-register the mortgage anyways if it's collateral, so we can change names on the mortgage. If it's not registered collaterally and you guys want to make a name change, the only way to do it is if the deal funds as is, and then after 120 days, you call customer service, small fee, and they'll do the change for you. So it's a bit of a 2-step process if it's not registered collaterally.
Yeah.
So if you guys have any questions on that, let me know.
Yeah, definitely. It becomes like it's very different from lender to lender when we're looking for any sort of title switches or title changes. Some lenders will say, hey, go to land title's office, do it before, then submit it. So that's all case by case. It's not very common. Typically, people that are just moving their mortgage are moving it because they're getting a better interest rate. Like that's like 8 times out of 10, right? A better interest rate. Very rarely do we have clients like, oh, I hate my mortgage lender. Like that usually doesn't happen because, like I said, you don't interact with your mortgage lender every day. But yeah, typically it's because, hey, I want to move my mortgage. My mortgage is coming up for renewal. My bank's offering me this, but you're going out there and advertising this, and I like that offer better, right? So that's it, and it costs them nothing. Again, it costs them absolutely nothing. And then also, I forgot to mention one thing is you can cap up to $3,000 in fees or any sort of there's like penalties or discharge fees or anything like that, right? So it's not like clients can get the cash out or cash back, but remember that asterisk at the beginning? The mortgage amount needs to stay the same unless you're capitalizing any sort of fees or any sort of discharge costs or anything, right? Do you want to maybe talk about that a little bit more, Emmett?
Yeah, it's super simple. So as you just said, like the mortgage amount has to stay the exact same. But exactly what you said, if there's any penalties for breaking a little bit early, if there are any discharge fees, admin fees, anything associated with breaking that mortgage that results in any interest accrued, penalties, anything like that, we can cap into the new mortgage up to $3,000.
Yeah, exactly. And again, just this one on this slide, and again, I just want to give you, I just remembered when it comes to HELOCs. So a HELOC moves over, for example, let's say a client has a $100,000 mortgage. Let's say this mortgage is at BMO, right? We'll pick on BMO. And he has a HELOC for like 30,000. So what would move over would be 130,000 as a mortgage to Merrick's under the collateral switch program. Again, it costs the client absolutely nothing. And we just lose 10 bips comp, right? Unless we're doing buy downs and stuff like that. That's a completely different story. So that's how that would look. It's not like the HELOC stays there and the mortgage comes here. Everything comes over, and it would be coming over as a mortgage, right? So,
quick question. So, Emma, you guys are going to pay $3,000 towards the penalty?
It just gets tacked onto the mortgage essentially. So let's say your mortgage is 150. If there's penalties up to let's say 2,500, then we can make it 152 and 500, basically. $152,500. Sorry, that was really awkward. But yeah, they would just cap in what the fees would be. So you can go up to 3,000. You don't have to use all of it. And it's just, that's what it would be.
Yeah.
So it just adds to the mortgage. Okay.
Right. Without it being considered a refinance. Anything more than that $3,000 would be considered refinance. You can't use that money to pay other debts. You can't do anything. It's only for capitalization of any sort of penalties or fees that, from your existing lender. Right. So, yeah.
Thanks.
Awesome. Okay. So the broker process, what is different, right? So what is different between this and a regular purchase in terms of our process? Not much, right? Everything's the same as a normal application. We try to get all docs up front, right? And every single document that I mentioned before, like, the mortgage statement, the insurance, all that stuff, try to get up front. Make sure you start an application on time because a switch transfer will take longer than a typical application. only because, again, there's an extra step of FCT going out and getting the paperwork signed at the client's house, that type of stuff, right? So try to give yourself a month before the mortgage is coming up for renewal at least. We can't do, if there's less than 2 weeks left and you're starting an application, chances are we won't be able to close on time. The clients will have to renew it into an open term, right? And so that's what they do is they call their existing lender, hey, I want to renew into an open term. Yes, it's a couple days or maybe a week of high interest, but allows them to move it over without now having to pay any sort of penalties on that switch or transfer, right? If they lock in or if it auto renews. That's a very common thing with a lot of lenders is it will, if the client doesn't make a decision on that, doesn't get back to them, they'll auto renew it into sometimes an open, but sometimes like a 6-month closed, right? Where you can't touch it now for 6 months. So tell them to call ahead of time and get it renewed into an open mortgage. And yes, it's going to be like 5%, right? 6%, but it's only going to be for a very short time, right? Obtain insurer reference number before the submission, if it's applicable. Like if it was previously insured, it's very important to get this the CMHC or Genworth or CG number. So one way to get it is ask the client if they have their initial approval letter or commitment. 9 times out of 10, they will not have it, right? It's 5 years have passed and they don't know where their paperwork is. And again, really, you don't want to give them too much of a runaround. These 3 phone numbers are your customer service numbers for the insurers. And you call them and say, hey, I'm so-and-so, I'm a mortgage broker, and I'm trying to get the reference number for this. And you're not going to know who the insurer is on that file. The client's going to tell you CMHC because that's the only insurer that they know. But chances are you'll call CMHC and say, sorry, we don't have that number on file. Then you call Genworth and you ask them, this is the address, this is the client's name. They're going to tell you, I don't have this number on file. Then we call Canada Guarantee and they might have the number on file, right? So the client's not going to know who their insurer is because frankly, who remembers? Like, I don't know who our insurer is on our properties, right? And so because it's not their job to know, and this literally takes 30 seconds, like per call, right? Sometimes you get lucky and you get CMHC, and that's kind of where I would start my search at CMHC, but call this number to say, I want to find the reference number. Every single time we've called, it's like one of the things that they do. So they're like, okay, yeah, no problem. What's the property address? Right? So they'll ask you the address of the property. What's the borrower's name? You give them the borrower's first and last name. Okay, here it is. And they'll just tell you, write it down. You're good. Right? So very, very, very easy to get this reference number from the insurers. And everybody's super nice whenever we call in for that. But that's something that we definitely need. Conditions need to be satisfied at least 14 days prior to the renewal date. Otherwise, clients may have to renew into an open term. And I talked about this. And the reason for that is because FCT will take over the file once the conditions have been satisfied. They'll try to contact the clients, try to arrange, they'll do their behind the scenes, title pulls and stuff like that. Try to arrange a time with the clients to go sign the paperwork. So they're acting like the lawyer in this transaction. And they'll actually go out to the client, right? It's part of their policy. They have to either go to their house or their workplace to sign the documents. Right now it's a little bit different during COVID. Some of them are doing the video meetings and stuff like that. But this is the typical process. And that's why it takes a little bit longer, is because there's no lawyer involved. It's FCT, right? And us as DLC, we can actually order the payout statement a little bit earlier. So we get a little bit of a head start on this for rush files. So if you ever have a rush file, definitely talk to me. It's a DLC exclusive program that we have with FCT, right? It's called the Platinum Refinance Program or the Platinum Program, something like that. But it's a DLC exclusive program. So Amity, anything you want to add to this?
Sorry, no, that was really good. I was going to say on the collateral, if you guys have collateral switch transfers, in your notes, always put that it's collateral switch, because the underwriter needs to know that stuff, because the process for them is a little bit different on the back end. And I know it might not sound like a whole bunch of different stuff for you guys, but for them, it really helps them underwrite the file faster.
Yeah, and assume nothing. Like, just because we know that TD registers that as a collateral doesn't mean that underwriters necessarily know that, right? So they're just trying to go through files, right? And trying to be as efficient as they can. There's definitely different paperwork they need to fill out, different things they need to do. So we need to write collateral transfer. This is a switch under the collateral transfer, program. So just things like that will definitely help out for sure. Okay, so why we should be targeting switch clients? Because in my opinion, a switch is one of the easiest transactions you can do. There's no down payment confirmation. We're not dealing with 5-day condition removal deadlines. And usually the clients are already qualified. Not always, but usually. right? Sometimes situations change, but they got the house once. If nothing has changed, and generally people will advance in their life and get maybe a better paying job or pay off some more debts. They're already qualified, right? So we can target them because we already know that most times they'll be qualified. And then everyone, like every mortgage professional, goes after purchases and realtors. That's the reality of it, right? So I think this is a little bit of an untapped market, is to go after consumers for their mortgage switches, right? And really just your marketing, just, hey, is your mortgage coming up for renewal, right? Ask me how we can save you up to thousands of dollars, right? You can quickly make like social media posts, all that type of stuff just based on that. And it's very, very easy. A lot of people, when they're switching their mortgage, will just sign the paperwork and just send it right back, right? Especially with the big banks, they'll send it right back. And most of the times the big banks will offer their clients a much higher rate than they're offering new clients to bring them on, because they know that majority of people will just sign those documents and send them back, right? Now, again, clients can call them and negotiate with them, all that stuff, but that's an opportunity for us to say, hey, look, you're getting 2.89. Well, I can do 2.69. Or hey, you're getting 2.69. I can do 2.49, right? On your renewal, it costs you nothing. And I got 3 months of interest paid for you, right? For example. So in my opinion, very easy transactions to do. Because again, like I hate down payment documents, and that's probably one of the most hated documents. There's no down payment documents. There's no down payment, right? And again, we're not dealing with the 5-day condition removal. We typically have a little bit of a longer time. Usually it's a month or 2 months, and you can start this process up to 4 months before, so 120 days before. And then why else we like it? Because we save clients money. That's the reason why they're switching, right? And then we get paid full comp on the mortgage amount, just as if it was a regular purchase. So it's not like we get a reduced comp unless it's like a collateral transfer or something like that, or unless we're buying down. But there seems to be a little bit of a misconception. If it's a renewal, then, or if it's a transfer switch, we get paid less. No, it's full comp. What else was I going to say? Oh yes, one thing is, if the client is already with the lender, you cannot switch them or move them or renew with that exact same lender. Now, that brings me to my next point, Merrick's and their trailers. Nice segue. You want to talk about that a little bit?
Yeah, it's a great segue. So I think right now the biggest thing that I've been telling agents is that it's pretty high level. So hopefully it's not going over your head. And if it is, then just let Sunny and I know. We could try to explain it a little bit better. But 5 years ago, obviously the changes were made to the qualifying for mortgages. So instead of the contract rate, you had to qualify at the benchmark rate. So right now, a lot of agents are combing through their database to see which clients of those couldn't qualify, because this is the last year they can transfer mortgages at the contract rate that's been grandfathered to get them anywhere else at that rate. So if you guys see clients in your portfolio that really had a tough time qualifying at, let's say 2.54 5 years ago or 3 years ago, this is a great time to get them into the trailer model, because it's going to be impossible for them to switch out later unless something in their situation changes drastically income wise. But if you know that they can't transfer later, this is going to be money in your pocket for the life of their mortgage. So that's something that I've been preaching quite a bit this year, since this is the last year for contracted grandfathered rates. So
you guys are doing the contracted the grandfather rates, right?
Yeah, exactly.
So maybe I'll touch on that really quickly because I didn't go over it. So if when did the rules change? Was it? Do you remember what month in 2015?
October 2016, right?
2016. Okay.
Yeah.
So if the client's mortgage was done prior to October 2016, we can actually qualify the client at the contract rate. So whatever rate the client is getting when it comes to switches and transfers only. And the reasoning behind that is because, the government's like, yeah, we don't want to trap the clients with their existing lender. So they'll do that up until the first renewal, right? So that's exactly what's happening is you can qualify them at the rate that they're getting if their mortgage was done prior to October 2016. After that, can't do it. After, we have to use 5.04 or whatever that qualifying rate is at that given time, right? So with the trailer model with Merrick's, for example, you do get paid a little bit less up front. So that's the difference between Lendwise and Merrick's, right? With Lendwise, you get paid more up front. with Merrick's, you get paid a little bit less upfront. It's still good comp. It's still going to be up there with a lot of other lenders. And then you also get a trailer. You know what the trailer, I'm sure you know what the trailers are. Amit, you want to maybe talk
Yeah.
about those?
Yeah. So it's 87 up front for the initial pay. And then it's 5 bips per year for the first term. So the first 5 years. So you'll end up getting pretty much full comp within your first term as any other lender. And then after the renewal, you'll get 20 on renewal, and you'll also get 20 for every year after that for the life of the mortgage. So you're going to get another 100, 110 bips in your second term, your third term, your fourth term for as long as they stay.
But it's not every year after, it's every term after that, right?
So after the first renewal,
Mm-hmm.
it's every year you get 20 bips.
Oh, really?
Yeah.
So you get pretty much 100 bips a year.
Yeah, exactly.
Insane.
So you'll get 20 beeps per year. So in your second term, it's 20 times 5, right? So you get 100 beeps in your second term.
100 beeps in your second term. Nice. Okay.
And 100 beeps in your third term, and 100 beeps in your so on and so forth until the mortgage pretty much is paid down. Yeah.
So it's every term. Okay, makes sense.
Yeah.
So, I mean, it's definitely good because like if there's something that you're going to be doing long term, it might be a good way to kind of set yourself up for just residual income later on. And Merrick's is one of the only lenders that has the trailer model. Like I know Dominion Mortgage has that trailer model. Guess who Dominion Mortgage is?
It's more of an actual renewal model. So
Yeah.
the Dominion Lending Centers will only pay you for the first term after renewal.
Yeah.
So you'll only ever make 2 terms of payment. With Merrick's, we're a real trailer model. So we'll pay you after the first, second, third, fourth term for as long as the mortgage exists.
Yeah.
A little bit different. So yeah, just something to keep
And a lot
in
of people don't know that Dominion is just Merrick's, right?
Yeah, it's all Paradigm. Yep.
All Paradigm Quest.
Yeah.
So,
Exactly.
yeah. So there we go. So that's kind of, that was a nice segue into the Merrick's trailer model. So that's the only difference between Merrick's and Lendwise is that Lendwise will pay more upfront, but then they don't give you the trailers, right? Whereas Merrick's will pay a little bit less, and it's not even that much less, like what, 20 bips?
Yeah. I think it's not even 20 bips. I think it's 15.
Yeah. And then, but you get, and again, you get that trailer. So at the end of the day, like if the client stays with Merrick's and Merrick's has what, like an 87%, you're saying 87% retention rate?
Yeah, it was pretty crazy last year. So in 2018, it was 89. As of 2019, it was 87. And they're being really aggressive on renewal rates right now, probably 5 to 10 beeps lower than anything on the market posted right now for new clients.
Yeah.
So they're being really aggressive, just like every other lender is right now. So anything you place there, it's going to be hard to transfer out because they're definitely being aggressive on renewal rates.
Yeah. That's one thing that, that's important to realize. It's easier and cheaper to retain a client than to get a new client. Right.
Yeah.
So, we'd be ignorant if we said that, lenders aren't trying their absolute hardest to keep their clients with them. Right. Because when lenders are moving, let's say, for example, when you're originating a new file, there's admin fees, there's, registration costs, you got to pay broker commissions, so it's expensive to bring that mortgage in. And so for a lot of lenders, that first term is a write-off. Like they don't make much money after they pay everything and pay everyone. And so really where they make the most money is going to be in your second term, right? When they've retained that client. So they're going to try super hard to retain that particular client.
For sure.
So keep that in mind. And that's why it might seem like banks are aggressive right now. But that's why, you're going to get banks trying to fight for that business. Now, the silly thing is when they send the renewal notice out, it's typically at a higher rate than what the bank is doing anyway. So again, a good opportunity. Where I found that's different is with monoline lenders. So monolines will offer, like Merrick's, for example, First National, these guys will offer lower rates than what's available for new clients right off the bat, right? Whereas your banks will try to sneak, an extra 15 basis point premium on that particular client. That's where we have that opportunity, right? To really say, hey, look, let's see if we can save you some money. Right. So, yeah. Okay. I got a couple questions here. Okay. Julie says, I have a mortgage renewing November 1st, 2020. This is doable, or should they renew earlier? You don't want to you got to figure out what their penalty is. So I wouldn't renew them earlier, unless it's worth it. And we can do the interest savings and kind of determine if it's worth it for them.
There are a lot of agents and brokers right now reaching out to lenders to find out what the penalties are, because the rates have come down so drastically from now since maybe a year or 2 years ago. So they are doing a cost analysis benefit on what the penalty could be versus what their rate could be right now.
Mhm.
So if you've got your numbers in line and you can do the math pretty quick, it's worth checking. I mean, if they've just renewed and they've got 4 years left on their term, probably not a good idea. But if they've got maybe 1 year left or a year and a half, it might be worth their while to actually see what the penalty is, especially if we're capping in 3K and it's less than that, then the client still pays nothing and gets a reduced rate.
Yeah. So rates are low right now. It's not a secret, right? So I would find out what that particular penalty is. In terms of, and this is kind of where it gets complicated, in terms of qualification, November 1st, 2020 is a renewal date. So that's off after October. No, wait, no, you'd still be good, right? Because I think it's good for 1 more year, I think, right?
I think it's good for till 2021, right? Yeah.
2021. So yeah, it's not an issue from a qualification perspective, but I would find out what that penalty is. If we can save them more interest, right? Then their penalty is, it might be worth just renewing early. Devin says that's good stuff. Great passive income. Yes, it is. For the trailer fee, do you need to work on the renewal in order to get the trailer fee on the second term? Not if you submit to Merrick's. Like, and that's the beauty of it. You just get paid.
Yeah, that's a nice thing. Like if it renews, you don't have to worry about it. It automatically renews. The clients are good and you get paid.
Okay. Gene also says, can I do my personal mortgage renewal with Merrick's?
Yeah, you sure can.
Awesome.
I think once you submit the file, I think this goes for pretty much every lender out there. If you're doing your personal mortgage, you just have to state that you're doing your personal mortgage in those notes so that they know. Just have to disclose it. I imagine. And Sonny, you might be able to speak more to that. It's been a while since I've been doing it, so.
Yeah, some lenders will allow you to do your own mortgage as long as you're transparent about it, and that's very obvious because your name's on the freaking thing.
Yeah, exactly.
But some will just say, hey, have somebody else submit for you, right? So in that scenario, again, nothing changes. I will submit on your behalf, and it's not like the splits or anything change. Like, it's all the same stuff. I have no issues hitting a button, and we can get it done for you. Good stuff. Is there any more slides, or is that it? Let's see.
Do you have any more slides?
No, I don't. Do you want to start yours, or did I kind of go over everything?
You did a lot. Let me just double check and see what I got on here, because maybe we missed maybe 1 or 2 things. But let me just double check really quick.
That sounds good. Do you guys have any questions in the time being for like just general switch or transfer questions? You guys are good? Are you guys feeling a little bit better about this now? Everyone's muted. Gene, what about you?
Me?
Yeah, do you feel a little bit better about this now?
Oh, yeah, absolutely.
Okay, good. Awesome.
Yeah, no, Sonny, you did a really good job. I think the only thing that I'm seeing is that we will cover any appraisals for switch transfers up to 375. And it's just a form that you guys have to fill out that I can send you if you don't have. It's right on the portal too. I'm just taking a look. It's got a lot of information about FCT in here, but pretty much everything you covered off.
Nice. Yeah. Okay.
And I think the biggest thing here it's saying is just prep your clients, let them know that FCT is going to call them, let them know who they are, what they do, why they're meeting them, that kind of stuff. Just a lot about prepping your client about what's going to happen for the switch transfer process.
Yeah, exactly. So Devin has a question. He says, when is the optimal time to switch mortgages for it to make sense in terms of a payout penalty? Is it 3 years into term? It's, you know what, it really depends on what their penalty is and what rate they have. And if they're going to be saving money. So I guess you would have to do a cost analysis.
Yeah.
But we have tools. Like, we have our app. Everybody here has an app, right? That you can do that very quickly and kind of, figure out if it's going to be worth it or not, right? There's no general rule like 3 years in. Like, if it's a fixed term, it's going to be an interest rate differential.
Yeah, I think pretty quick as well if the clients are with a really big bank like TD, for example, Scotia, ATB, you'll know that their penalties are much higher than a monoline lender just right off the hop, because that's just how they operate. So if you've got a client with TD 3 years left, it's probably going to be a massive penalty. Versus we're monoline lenders, we calculate penalties based on the actual going rate, not on the benchmark rate. So it is worth it to see maybe who they're with first before doing more digging, essentially.
And then also like just have them call in and find out what that penalty would be to break, right? There's no point speculating. I mean, there's definitely calculators and stuff available online where you can do that calculation for them, but the most accurate way is just have them call, hey, what's my payout penalty going to be right now?
And every lender has to give the information as of that day. So they can't say, why do you want it? Why are you calling? They always give it. They don't hassle you on it. So don't tell the clients not to be scared to ask for it.
Yeah. And then so we can make the determination. Like if the client's interest rate's like, 2.59 and we're doing 2.49 and they have 2 years left, like it doesn't make any sense. For 10 basis points in a reduction, like they're gonna lose money. Right now, if their rate is like 3.25, which was the case like a little while ago, a couple of years ago, then yeah, it might be worth it. Right? It might be worth it. So it really, really, really depends.
Yeah.
Awesome. Any other questions, guys?
I have a question. Amit, do you think you could go over, can you hear me okay?
Yep.
Do you think you could go over this promo with the interest-free, like the 3 months? Yeah.
It's honestly, there's literally no strings attached. It's interest-free for 3. So basically the payments are all going to stay the same. The clients won't have to do anything. We just pay the interest portion for the first 90 days. Clients don't have to call in and say anything that we're changing payments or anything like that. It just automatically switches after 90 days. It's a full feature. It can be combined with any of our programs, whether it be Purchase Plus, Flex Down, really anything except for Business for Self Alt A. Otherwise, it's good for any other program.
So can you give me an example of that number-wise? Like, let's say the mortgage was a certain amount, and what would the interest be on that, so I can get an idea?
Yeah. So one of my colleagues did a cost analysis today. I can actually send Sunny the email that she sent me, and I can get it to you guys. But right now, saving 3 months of interest on a 500K mortgage as just a benchmark, the rate would be 2.39 instead of 2.54 essentially.
Okay.
Does that make sense?
Equivalent of, yeah.
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 So we ran the numbers. We did apples to apples. What the savings would be with interest and what the rate would be based on the interest saving. So.
Okay. Thanks.
Yeah. So I can send you guys some information. I'll send Sunny the information. He can send it out to everybody. But it does have a huge benefit. I know 500,000 is a bit much for our economy, so you might want to run the numbers at 300,000 as an average, and then maybe take a look from there. So
yeah, I remember even Merrick's has some marketing material. I think they use like 350,000 as their
the benchmark. Yeah,
the benchmark, and I think it was like $2,500 that the clients
Yep.
saved in 3
Yeah,
months.
I saw that too. I think it's about $750 a month. So I think it ends up being around 2,100.
Yeah, something like that. Yeah,
approximately.
And it's not like it's capped anywhere. It's not like it's you don't pay interest for 3 months. No, it's interest paid by the lender for 3 months.
The only caveat to the program is the payout penalty, and it has a declining administrative fee every year the mortgage passes. And I can tell you guys. I can actually just share my screen here, Sunny. There is a pretty good
Yeah, go for it.
slide here. Can you guys see this okay?
Yep.
So this is based on a $325,000 mortgage at 2.54%. This is kind of what you would save. Can you guys see that okay?
Yep.
I can send this to you over to you, Sunny, as well, if you guys want to take snapshots of this. There's some really good marketing material too if you guys want to post on your Instagram. I think I sent Sunny a few things as well, so feel free to reach out or let me know. I can send it directly to you. There is, just wanted to show you guys. Why can't I find it now? Sorry, guys. I thought it was on this one. Let me just take a quick peek and see if I can see it on this other slide. Oh, yeah. Okay. So it says the penalty is it's an administrative fee starting year 1 at 0.75%. And then year 2, here, I'll share my screen again. So this is, can you guys see this okay?
Mhm.
So this is what the admin fee looks like for using this program. So it's just a little bit of a higher penalty. And then it's obviously either the greater of the IRD or the 3 months plus the administrative fee based on what year you're in. So this is the only real caveat to the program. Any other questions?
I think I'm good. What about you guys? Okay. Awesome. No, I don't think there's any other questions. If there is, please ask.
Yeah, let me know. You guys have my contact details, so feel free to reach out. I think Sunny can attest to the new underwriter that we've got working for the team, and she's awesome. So feel free to give her a shot, and we'll go from there.
Yeah, no, we just got a new underwriter, and she's really good. So we gave her a whirl with a couple files over the last couple weeks, and she's on top of it. One thing I like about her, if the file doesn't work, and she can see, she'll first try to find a solution instead of just declining it and sending it back.
Yeah,
Right. So she'll try to figure out, see if she can kind of tweak some things and offer that as an option instead of, just declining it. So
Totally.
and she's quick, and she's full service. So she'll look at documents and everything as well as the underwriting. Typically, when there's one person looking at the documents and one person underwriting, a little bit of a disconnect there, right? And it can take a little bit longer, and so this is a little bit easier. So if you have any questions pre-submission, reach out to Amit. And, we all know his information, but I can definitely share it with everybody after this. If you have any questions about your deal after submission, reach out to your underwriter. She's good on the phone too. She's awesome. I don't have anything bad to say about her. She's really good. She's quick on emails. And yeah, she's true to that 24-hour turnaround time and quick doc review. So we're good.
Yeah.
Awesome. Any other questions, guys? Okay.
Cool. Thanks for having me, Sunny. It was really good. Hopefully it was informative. If you guys have any questions, obviously reach out and we'll go from there.
That was good. Cool, guys. If
Thanks,
there's anything
Sam.
else, then
Thanks,
let me
Emma.
know. If not, then yeah, have a great day.
Okay. Thanks, guys.
See you guys.
Thanks.
Okay.
Thank
Talk to you in a bit.